All right, hello everyone, and welcome back to our virtual finance seminar series in corporate finance and investments. My name is Andrei Bodnaruk. I'm from the University of Illinois at Chicago, and today I'm joined here with my co-organizer from Michigan State University, Nuri Ersahin. And we are very happy to have H. Chen from University of Notre Dame, who is going to present his paper, Investor Competition and the Cost of Capital. Before I pass the microphone and the screen to H. Chen, um, let me remind you about the rules of the game. So you're all going to be muted and we're not going to see your faces, but you are very welcome to type your questions in the chat. And when the time comes, we're going to read these questions to our speaker and you will have the opportunity to hear his response. So with that, again, I'm very happy to have HN today and the floor is yours. Thank you very much.
Thank you so much, Andre, for the invitation to come and talk about my research at the Virtual Finance Seminar Series. It's really a great honor to join the list of the very accomplished researchers that have graced this program. My name is H, and I'm at the University of Notre Dame. And when Andre sent me an invitation to come and give a seminar, I think early in January, I was absolutely ecstatic. But immediately after, I kind of realized I actually have to write a new paper first. So this is very preliminary work, and it's first outing in public, but it's on a topic that many in this audience have studied and know a lot about. So I hope that you find the empirical facts documented here very interesting, but I look forward to hearing your comments and suggestions, especially about the interpretation of this data. So I want to start off by just listing some basic facts about the delegated asset management industry. To start off, fact number one is that this industry has grown very large. There's thousands of funds presiding over trillions of dollars in assets. Fact number two is that this industry has some very large players. We're familiar with Fidelity, Vanguard, and BlackRock. Many funds come under the umbrella of just a handful of key management families. And fact number three, which is that these families participate as almost a single entity. Fidelity buys into IPOs, bid for treasury securities, and lend together through repos and other short-term securities as a large delegated investor. And I think this last fact is very interesting and drives this project because it challenges the way that we think of what a classical investor looks like and how they price assets in a competitive equilibrium. While classical models of markets assume infinitesimal price-taking investors, the growth of these large delegated investors begs the question of whether such assumptions are still valid for asset classes invested in by maybe a handful of asset management firms. And the question that I really wanted to focus on today, and I think I make varying degrees of progress in answering this question, is how does the relative size of these delegated fund families affect or is at least related to the cost of capital to issuers? What type of characteristics of the IO of asset managers, right, have in common with asset prices themselves? And I'll present some evidence indicative of one view in a very specific topic, but this is ongoing work. And again, I would love to hear your comments and suggestions on what's happening, because after all, asset pricing is a first order topic. And as an empirical fact, these large families, which came into being in the past several decades, are not going away anytime soon. To study this question, we're going to zoom in into the setting of money market mutual funds. This is a setting in with a limited number of large investors that focus exclusively on liquid and very, very high quality securities. Money market funds focus on the extreme short end of the security maturities. So essentially all portfolio returns comes from payments and the lending terms by the delegated investor to borrowers. And I want to emphasize that risk-taking in this market is heavily regulated. There's been substantial work in the finance literature on reaching for yields in this particular market. And the regulatory paradigm in my sample period, that is the past 10 years, is to prevent this type of reaching in yields in this market. And so not all funds are required to have 97% of their assets in what's called first tier securities that satisfy some sort of liquidity and risk requirement. And I'm going to just show some correlations of measures of borrowing yields or lending yields with respect to the size and market shares of the various delegated managers that work in this market. And that's our most basic form of variation. So this paper is essentially documenting an effect on relative size and returns. And then we're going to zoom in to possibly the largest regulatory reform that happened in asset management over the past 20 years, which is the money market mutual fund reforms of 2016. And I'm going to look at how that changed the size of different players and possibly convince you that there's a change in just the competition structure of players in this market that's related to the way they charge asset returns. So without any ado, I'm going to formalize our analysis here. The null hypothesis, common to most finance literature, is that delegated investors are uniform price takers in the security market and receive returns that are pretty commensurate to the risks of the securities. And alternatively, the hypothesis that I'll try to propose and test in the seminar today, which I think can be reasonable in short-term markets, is the pricing power hypothesis, which is that delegated investors have received variable pricing. The evidence I'll suggest today, or I'll present today, will suggest that this variation, this heterogeneity in terms of prices, has less to do with risk and has everything to do with relative size. There can be differential pricing for similar securities in the money market funds market that's reflected on differential market shares. So there are three major types of money market funds. One of the major types is tax-exempt funds. The others are prime and government types. Right? They each invest in different types of security markets. So we're going to look at them separately. This picture plots the average gross portfolio returns, so returns prior to fees for the tax-exempt money market funds. The y-axis is the value-weighted average month-end money market yields. And in the blue, I take the tax-exempt money market funds within the largest 5 money market fund families and just plot their average yields. That's the blue. And then in the orange is just the average yields of everyone else. And we clearly see a divergence between these series starting in 2015 as interest rates became higher on average. The largest fund families are able to obtain higher yields from their borrowers in their portfolio prior to expenses than other money market fund families. And I think at this point, we already have something that's less easy to reconcile with standard finance assumptions. We can believe that the top 5 families are much more likely to reach for yields than smaller families, but that would go against the evidence that's already presented in the empirical finance literature. Right? So Kabarjek and Strobel's QF and QJE, to a lesser extent, DiMaggio and Kabarjek's JFEs that was published in the past 5 years, all find that independent upstart funds, given the short term, given the opportunities in the short term, tend to have higher incentives to reach for yields. But instead, we see that the largest families have actually been receiving the highest yields. And I think this graph is kind of interesting because it describes the inverse of the economies of scale relationship that is in typical mutual fund literature. This pattern repeats itself in the prime family categories as well. So that was the tax-exempt categories of funds. This is the prime category funds. And in the prime categories, this gap seems to be the largest and most significant. To make those two slides comparable, I deducted a marginal tax rate of 35% from the prime categories. It's just multiplying all the yields by 65%. But that doesn't really change any of the results. Through the main sample period, the marginal tax rate have kind of remained constant at about 40%. I want to stop here and just hear your thoughts on this. I mean, is there something I'm missing in terms of this market? What do you think is happening on the market? The more you kind of try to reconcile this graph, the more I kind of have to think about demand side arguments or some type of heterogeneity in terms of the issuers, and that larger parties are able to select better the higher yields. But this is difficult because this is a relatively homogeneous short-term securities market. And I would love to hear some comments right now if anyone has them.
So one comment I have is, if you look at both of these graphs, there seem to be the results seem to be driven by the second part of the period. So there seem to be a very little spread, if any, prior to the mid 2015.
Yes.
And then there is the significant spread of this second half of the period.
Yes.
Is it related to this regulation that you mentioned, or there's other explanation that you have in mind?
Oh, there might be something in kind of the macro credit spread literature that says that the lenders can take better advantage when, say, the average interest rate is higher. But when you go down into these arguments, there's some type of monopolistic argument about the lender. And if we zoom in to the treasury-based money market fund categories, categories where there really wasn't substantially affected by the 2016 money market reforms, we see that these two yields almost follow each other continuously through this period. Only until around 2019 do we see a divergence, and that may have something to do with other things that's happening in the money markets. So for second part of the paper, what I'm going to zoom in is exactly what Andre mentioned, which is the 2016 money market fund reforms. And this vertical line marks essentially when the SEC instituted these reforms to the money market funds to kind of essentially prevent potential future runs by institutional investors. So this reform was instituted directly as a response to all the findings between 2008 and 2015. And I'll go over the main reform rules in just a few slides, but the gist of it is that it instituted redemption gates and liquidity fees, in particular for tax-exempt and prime funds. This had the major effect of shifting AUMs from that market to the treasury market and causing almost a shift in terms of measures of concentration, measures of competition within the prime and tax-exempt categories. Okay. And for kind of the bit more exogenous evidence, what I'm going to do is zoom in and not high frequency, but say monthly frequencies before and after these reforms to just look at what the large families did and what the small families, what happened to the yields in the smaller families.
Could some of your results be driven by the fact that larger families may be able to safely handle more risk in their investments?
That definitely could be the case. So riskier investors select for larger fund families, and they have some type of heterogeneity in terms of their marketing power or some type of competitive advantage versus the smaller fund families. And right now, I still can't distinguish that versus, say, some type of bargaining hypothesis. But that is true. I mean, in the end, right, the result is just about the heterogeneity of these delegated investors. Larger ones seem to be able to get these higher yields from borrowers, and I'm looking at evidence of, say, holding changes and issuer changes before and after the specific date, institutional reform date. And right now, I haven't found anything that's indicative that larger or different issuers suddenly change parties dramatically for the large families. So if you just focus on the issuers that stuck with the largest families and look at their yields, most of these results are essentially the same.
All right, thank you.
So we're going to, so that's essentially the gist of the paper, right? As kind of the main results, there's this positive association between a fund advisor family's market yields and their size, their relative size, their market share within the money market mutual funds market. That's a mouthful right there. And this is almost pretty much entirely situated in the prime and tax exempt categories of funds. So one standard deviation increase in a fund family's market share implies roughly 2 basis points of additional short-term yields. 2 basis points is tiny, right, compared to equity yields or long-term 30-year yields. But in the short-term market, right, short-term risk-free market, that's depending on which horizon you're looking at, that's 5% to 6% of the total returns in these categories of mutual funds. The second result that I want to point onto is for the main results, we're looking at the portfolio level, right? But everything is composed of individual securities. And with the data that I've collected for this project, we're able to directly look into, say, securities themselves and look at their reported yields. And you can construct a measure, right, based on the ownership by these large families. So you can look at, say, a security percentage owned by the top 5 families. Take that as a regressor, run that regressor against yields, and you'll see that it's positively associated with interest payments, with security yields. So it looks like if your primary lender is a large investment family, you do pay more, whether that's because of self-selection or because of some type of implicit bargaining game. We can't tease out that relationship. Those are the main results. And then for the second part, I want to zoom in on the biggest money market fund reforms of 2016. These reforms prompted exits by several major mutual fund families from the tax exempt and prime categories of money market funds. And I'll show that along with a decrease of the amount of AUM in these markets, there is also an increase in common measures of competition. I'll show you Herfindahl index, and I'll show you the concentration of the market owned by the largest fund families. And they're all consistent with a potential decrease in how these funds compete with each other. The next thing I'll show you is that we'll look at the yields before the reforms and after the reforms. And I'll just set up in a difference in difference regression to look at how differently did the top families react to these reforms than the small families. And what I find is that on average, the larger families in the tax exempt and the prime families raised their portfolio yields by 7 additional basis points than the smallest fund families. And lastly, if I have time, and this is something I'm working on, I want to zoom in to kind of just the microstructure of short-term securities market. There's interesting aspects of the short-term securities that indicate there might be some type of vertical integration. So I call it a self-dealing channel because you oftentimes have these large families who are both asset managers and provide other kind of services for these for these borrowers. And one of those services is actually setting interest rates on these securities. So if you are a municipal borrower, right, you're the state of Illinois, and you're borrowing in the short-term market from these mutual funds. Well, what happens is that you actually also depend on the same mutual funds to tell you how much you have to pay them. And the parties that set these rates are called remarketers. And what I find is that if you have, say, JP Morgan as the remarketer of your securities, and JP Morgan also hold your securities, so they're also the direct money market funds that lend to you, you're going to pay slightly more than other borrowers from that depend on JP Morgan. So those are my main results. The data comes from the MMMF filings that have become mandatory for money market mutual funds at the end of 2010. As far as I know, the only other paper that used this data was Pan and Wan's 2018 JFQA paper that they looked at repo rates that's extracted for this data. But this data is incredibly rich about all the things that you ever want to know about money market funds. So it has detailed holdings information, like what type of repos, is exact repos that are within your holdings, the type of assets that go in backing these repos. It has commercial notes. It tells you how much security yields are in these holdings, and it tells you the gross portfolio yield, which I'll focus on in this presentation, that these funds directly obtain from these holdings. I'm in the process of combining this data with various sources of securities information. One of these sources for tax-exempt securities comes from the Municipal Securities Rulemaking Board, and that contains all the floating interest rates that these securities borrow at the month end or at any date. And I'll go over what the MMMF filings look like. This is a filing on a particular investment fund. So a fund that comes from Fidelity Management and Research that was filed in, I think, 2011. And it tells you exactly who the investment advisor is, the total assets of the fund, and it also tells you information on the asset classes and holdings. One item that we'll focus on specifically is a very kind of regulatory item that's used by a lot of money market investors, which is called the 7-day gross portfolio yields that is very standardized across filings and families. There's an explicit definition of this yield as the hypothetical one share at the beginning of the period, dividing the difference of the value obtained by the returns annualized. And this deduction specifically should not reflect deductions according to shareholder fees and fund operating expenses. And that's the Y variable that I'll show you in many regressions. So this particular fund received a 40 basis point of yields, annualized yields, at the end of January 2010. And I collect this data from January 2011. I collect this data from January 2011 all the way to November 2020. also has a lot of portfolio level information. So it'll tell you exactly who the issuer of of an individual asset is that's under advisory by the money market fund. It'll tell you the CUSIP if it has a CUSIP. It'll tell you what type of holdings there are, and it'll tell you of as much as you want about these securities. And to make it comparable, I'm going to focus for some of the tests, the panel of securities by time information. We'll focus on mainly securities that have CUSIPs. So these are tradable short-term security assets that's held by money market funds that probably are not repos, because repos typically do not have CUSIPs. So this is a data summary of the money market funds and their respective yields. I separated out funds by taxable and non-taxable because yields are slightly different for taxable funds, right? You have the tax advantage, whereas the taxable funds, typically when you compare it to tax exempt funds, you have to multiply it by the highest, by a deduction for the highest marginal tax rate. The data is technically available since November 2010, but because we're focusing on fund families and advisors on kind of large family level, several top families were missing from the data until 2011. So federal rated investors didn't come in until January. And that's why I started the sample in January 2011. There's about 63,000 fund time observations with unique funds and families. In the whole sample, I observe about less than 1,000 unique individual funds from about 160 unique fund families. I think I saw.
Okay, here's a clarification question. So what is the relationship between the size and the yield at the fund level, not at the family level?
Depends on which kind of fixed effect you put in. So if you put in, depends on which measure of fund it is. So if you put in log assets, it's actually slightly negative. And if you put in market shares, it's either negative or non-significant. So if you just do a horse race between family market shares and say other measures of fund size, then what comes out of it is that family fund shares tends to be the positive predictor of yields. And there is an aspect of collinearity involved, so it takes a bit to kind of interpret the data. Overall, from the regression that I ran, it tends to be negative or at the fund individual fund level.
Okay.
Here is a summary of the holdings of money market funds. And tax exempt money market funds tend to be primarily invested in what's called variable rate demand notes or tender option bonds. These are notes that always have a fixed par value. So one share of, say, Illinois variable rate demand notes is always worth a certain amount, and that doesn't change over time. It's the amount that these assets pay to lenders that change over time. And so majority of these holdings come from these variable rate demand securities. About 16% comes from other short-term municipal notes. And then we have various different other kind of securities that are marked in these tax-exempt portfolios. I mean, there's clearly, they hold a clearly different set of assets, mainly because of regulatory requirements. You have to hold tax-exempt securities in order to have this tax-exempt status. Prime money market funds primarily lend through commercial papers. So short-term corporate debt and CDs, and there's some repos on their portfolios. But these two are very much different from treasury money market funds. And treasury money market funds primarily lend through treasuries, that comes from their name, and other types of treasury-backed repos. So these are tri-party repo agreements that between a borrower and a lender that's backed, right, backed by treasury securities.
We have a couple of questions here. So the filings that you use for your data,
Yes.
these filings are ex ante or ex post, and do the yields revisable during the life of the security? So for example, updates of yields between different issues on the same shelf register.
That's a very good question. I do see number of amendments in this data, but overall, there's no indication that what's changing is the security yields, or at least the amendments are changing the security yields. The 7-day money market fund yields are really a standardized element in money market fund disclosures. I mean, this is how investors benchmark their performance, look at how much they earn over time. So at least at the amendment level, it's very unlikely that the portfolio yields are substantially changed over time. For individual securities, though, there is some variation in the way that different families report and yields. Right? So Fidelity may calculate yields at a security level, right, differently from say Vanguard. And this is implied yield to maturity, and so there are data points. There are securities in the data where you look at January 2010 yield, 2011 yields, and two different families will report two different yields. So, for cases like this, what I do is I calculate the average yield. When we zoom in to say the change between the reform change in 2016, there's no real indication that, I mean, we're really just focusing on just months before and after the security change. So it's hard to kind of think that a whole family just changed how they account for every security on their books at these reform dates. The money market yield is kind of the specific interest that accumulates onto the portfolio at the end of the month, in the 7 days at the end of the month. And so that's fairly standard and kind of are calculated relatively model free. So it's hard to think that that item changes. And for the security level yields, it might be a bit more noisy.
All right. Do you see the same patterns for both institutional money market funds and retail funds as well?
That is something I have not checked for prime funds. I am in the process of checking that, but for tax exempt funds, there really is only retail tax exempt funds. There's the AUM under what's called institutional shares of tax exempt money market funds is non-existent. So definitely the case that that difference in classification doesn't matter for tax exempt funds. There may be something that happens in the prime funds, but I definitely, that's something I haven't checked. I will check that.
Okay.
So our first set of regressions simply runs the Y variable that I focused so much time on, the gross yields on a parent family's total market share. So in this regression, the X variable is the total percent market share that's held by a fund's parent family. And the Y variable is a fund's gross portfolio yield. For prime and government funds, just to make these coefficients comparable across each other, the Y variable is, or the yield, the gross family yield that funds report is multiplied by 65% to scale for taxes. And we see that on average, tax exempt and prime funds that's owned by families that have large market shares tend to, on average, pay higher gross returns than smaller families. One standard deviation of market share is roughly 5%. So one standard deviation of market share moves to about 2 basis points of return in prime and tax-exempt funds for the whole sample period, and slightly higher for these funds in the second half of the sample. For taxable funds, we don't really see a huge difference in these gross yields. So there's something about taxable and prime markets that makes it easy for larger funds or larger fund families, larger delegated investors to obtain higher returns. And this regression I ran with stuff like log fund size, family size as a pure AUM, and at least the market share variable stays, the coefficient on the market share variable of the family stays very similar. We can also weigh these regressions by fund size, and the results are even more dramatic. So something about these large funds or large fund families are giving them higher returns in the municipal in the money market funds. So if the portfolios are getting higher returns, their underlying assets must be paying more. And in this panel, I regressed the security yields of assets in the prime portfolios. And to make this panel standardized, I remove all repos and assets without cross-referencing CUSIPs. So as long as you own you're an asset, right? If you're an asset owned by a prime fund and you have a CUSIP, you're in this panel of regression. Since multiple portfolios report yields for the same securities, and these numbers often differ, I just use the median reported yield by most families as kind of a way of standardizing these regression yields. And I regress this variable against the percentage of this asset that is held by the top 5 fund families as a regressor. The first 2 columns are for the whole sample period, and columns 3 and 4 are for the post-2016 period. And we see a very similar pattern. So higher percentage ownerships implies higher security yields. The percentage ownership has a standard deviation of about 30%. A lot of assets are either owned by a top 5 family or not owned by a top 5 family. So the standard deviation of this variable is fairly large. If we multiply this 30% by this regressor coefficient, we get anywhere between 1 to 2 basis points of higher yield payment from this supposed to be a tier 1, super safe, super short-term security. We can separate security by types, looks exclusively at short maturities versus long maturities, look at securities with just 1 month left in their maturities, and we will find a very similar result. We can also do this regression for the assets held by tax-exempt funds. So variable rate demand notes and other short-term maturity muni notes. And again, we find a similar pattern. If you are held by a large asset management family, you typically have a higher cost of capital compared to assets held by a smaller asset management family. This is true for the whole sample period and also the second half of our sample period after 2016. These are endogenous evidence, but it tells us there is this, I mean, it doesn't seem like, it's hard for me to think that biggest funds or biggest asset managers always reach for yields. And this contrast seems to at least tell you that there might be other things happening in this short-term market than purely some funds are taking more risk than others, especially if it's so easy to predict by just their family size. We typically think that larger families have higher brand values, other assets that's associated with their holdings, and then they if they fail, right, or if they take excess risk, they are punished by some type of reputational issue. So this is the first half of this presentation. For the second half, I'm going to zoom in to the 2016 regulatory reform that is supposed to kind of fix the things that went wrong in the 2008 financial crisis. So the 2016 money market fund reforms had the following details. It required tax exempt, well, just essentially non-government money market funds to distinguish themselves between retail and institutional shares. It instituted floating rate net asset values for institutional shares of prime and tax exempt money market funds. But the most important provision was that it required liquidity fees and redemption gates for all non-treasury type institutional money market funds. If you're a large institution and you're taking out, I think, more than 30% of your AUM from these money market funds, the asset manager could potentially put a redemption gate, meaning that you have to wait a few days before you take the assets from these funds and use it elsewhere.
A couple of questions before we move forward. So how are these yields computed? If an asset is held by both large and small funds, is the reported yield always the same?
If on the asset level or on the portfolio level?
I assume on the asset level.
So for the whole, if it's an asset that's held by Fidelity, what I've checked is that the yields tend to be the same. If there's two different funds within the Fidelity family that owns this asset, the security yield is essentially the same. For if this is an asset that's held by, say, Fidelity and also Vanguard, there are minute differences. I mean, they're highly associated, but these yields, they often report different security yields on the asset level.
Okay. Did you do this analysis for the same issue to see if top 5 families get higher yields than other families? Are the yields based on primary or secondary markets?
The yields are typically, well, these are month-end portfolio yields. So they're marked to market if they can be marked to market, or they're marked to some type of asset valuation by the funds themselves. So they're month-end portfolio yields. And for the question about issuers, if for these regressions, if you put in, because these are CUSIP level securities, I can take the first 6 digits of the CUSIP, that would be an issuer. And you can put in issuer fixed effects and issuer times time fixed effects, and these regressions actually look slightly stronger. So now, it still doesn't really completely disentangle a selection story, because if you are a large issuer, maybe you'll go to a larger fund for a specific type of securities versus a smaller fund for different types of securities. But I can identify the issuer and put in controls for the issuer. So if you are a security that's held by a top 5 family, and you're compared with a same security or a different security from the same issuer that's held by a non-top 5 family, then the security held by the top 5 family tends to have higher yields than the smaller family fund from the same issuer.
Okay.
So let's look at what happens to the money market fund landscape with these regulations. These reforms, which were instituted as a direct response to the events occurring during the financial crisis of 2008, dramatically changed the money market fund family. In the orange, I have the amount of assets in prime funds. And in gray, I have the amount of assets in tax-exempt funds. In blue, I have the amount of assets in what's called treasury government funds. And we see a split difference. Most of these fund families either exited entirely out of the tax-exempt prime market, or they moved the AUMs into the treasury market as a response to these regulations. And we see that this shift really changed the relative size of families and funds within these within the money market fund market. And there's only a limited number of players. It's not as if I'm dealing with a million different issuers. So we can directly look into funds and their AUM before and after these regulatory change. These are the largest funds of families within the tax-exempt money market fund category. And we can look at what they were saying to investors around this time. So SEI Investments exited out of their tax-exempt money market funds. And they said that the decision to liquidate the existing funds is really because of the imposition of the redemption gates and liquidity fees. That's a concern to the institutional investors. This is true for other funds. So Bank of America advisors exited the market as well. And what they did is they transferred their assets into BlackRock advisors during this period. UBS also mentioned that they exited they exited some of their funds due to the establishment of liquidity fees and redemption gates. And we can look at what happens to common measures of concentration and size within the various different categories of money market funds. This is a summary of the number of advisors in this column, the Herfindahl index, and the top 5 concentration in prime fund between 2015 and 2017. What we see is that the number of advisors operating prime funds went from 85 down to 36 in 2017. The Herfindahl index reduced or increased dramatically, and the percentage of total assets held by top 5 families went up dramatically. And this is almost mechanical because you have a lot of exits of different players. So we're going to look at essentially the players that did not exit this market. This is a similar graph about tax-exempt fund families as well. Prior to the regulatory change, this is already a pretty concentrated market, but after 2016, it became even more concentrated. So going from 37 down to 22 advisors, a Herfindahl index of 11 to over about 17%, and a top 5 concentration of 60% to over 80% in terms of total assets. And for this part of this talk, what I'm going to focus on is just this regulatory change and how fund families responded, what happened to the portfolio yields before and after this regulatory change. We'll zoom in to 6 months before the regulatory change and 6 months after the regulatory change, and just compare large families versus small families around this period. We'll zoom into 3 month, and I'm going to vary the bandwidth. So 3 month all the way to 12 months and show you results. And these results are widely similar. So to start off, let's look at gross yields of prime fund families. And we'll just look at the yields received by the top 5 families after the change versus the yields received by everyone else after the regulatory reform. We'll look at 3 month horizons, 6 month horizons, and 12 month horizons. So just varying bandwidth strategy for a difference in difference. And this regression here is just the gross yields of prime funds in the sample period. So 3 months before in column 1 and 2, 6 month before and after in column 3 and 4, and 12 month before and after these regulatory change. The regressors are the typical difference in difference regressors. So I have a fund fixed effect, or the top 5 family fixed effect at the top. Right? If a fund belongs to a top 5 family after the regulatory change, that's an indicator of that for a fund. I have the post-reform indicator, which tells you which just tells you whether this happened after the regulatory change. This panel is occurring after the regulatory change, and the interaction, which is the typical difference in difference estimator. And the columns 1 and 2 are different because I use either time fixed effect or fund fixed effect. And what we see is that the largest top 5 funds that's managed by the largest top 5 families tends to actually receive on average a 7 basis point higher yield than smaller families. And you can put in a fund fixed effect as well, or you can put in both fixed effects. But the result that you'll get is that the fund at the fund level, the top 5 families got or raised their rates when you detrend the data with respect to other funds, and but after this reform window. This is relatively stable between 3 months, 6 months, and 12 months. And one of the interesting things about this difference in difference is that if you zoom into 2016, right, a lot of different things were happening in 2016. In 2015, Trump was elected in November. In December 2015, Federal Reserve decides to raise their fund rate for the first time in a long time in December. If you zoom into a +3 or -3 window, these things don't really incorporate these changes. So you can zoom in even to 2 plus -2 window, and you get a very similar result, which is happening potentially independent of other events in the short-term markets. I can look at this relationship for tax-exempt funds as well, before the regulation and after the regulatory reform. And we typically see a very similar set of results. In the 3-2 window, if you are a fund operated by a top 5 tax-exempt family, you improve your yields by about 2 basis points. And if you zoom into the 6-month window, you get about 7 basis points of additional incremental return over smaller fund families.
I have a question here. So wouldn't it be fair to say that there's top 5 families are always there to provide capital versus the rest are, pick and choose?
Yes.
And when they pick and choose, they basically have to give up some of the yield for the privilege of, picking the investment they want, while basically top 5 families will absorb all the remaining demand for capital and therefore will be, offered a high yield as a result of it.
I think that's a fair channel to test. And as it is right now, I can't completely disentangle a selection issue on the demand side and some type of bargaining channel. But overall, right, it's one of those results that suggests that these large fund families are much more like the way that we think of in terms of an investment bank. Larger families seem to be able to get these yields either because investors pay them more, right, or because these large families charge them more. And that part is something I'm kind of thinking about between a kind of a supply side versus a demand side argument. But as far as it is right now, I can't disentangle those two hypotheses.
Okay.
But that's something to interesting, and I'm thinking about. I'll have some results that's indicative of a kind of a supply side bargaining, mostly due to kind of the relationship between various different remarketers and the individual security, because you can you can look at, when you're looking at short-term notes, they're refreshed every month or every short-term period. And as soon as these securities kind of expire, you have a new fresh set of securities. When we're looking at tax-exempt securities, the rates are variable, but there's never a refreshing of kind of your holdings. And what I see is that if you are managed by a remarketer that's within these large, that's affiliated with your money market fund, you get charged a higher fee. And that I mean, it's almost that can you can control for how much fees you were being charged before versus how much you get charged in terms of fees after these after a certain period, and that is suggestive of some type of supply side bargaining argument. But that's preliminary so far.
So here a suggestion that you may be able to test the bargaining power story by exploiting the heterogeneity in issuer and time at which they raise capital.
That's definitely something to look into. Okay. No, these are great comments. So we can look into the treasury market, where we don't see the increase as dramatically, or at least an increase associated with these reform change. Throughout 2016, the amount of the Herfindahl index and also the top 5 concentrations for government funds stay relatively stable through the year, through 3 months after, through 3 months before, through 6 months after, through 6 months before. And I can use this as almost a placebo test on portfolio yields. And this is what we find if we simply focus on these treasury money market funds. On average, largest government funds seem to have some higher yields than smaller ones. But these aren't really brought in by the change in regulation, by the change in the competitive landscape. We see that the difference and difference estimator are mostly very small in magnitude and mostly non-existent for 3 months before and 6 months before and after. Only if we zoom in to a 12-month window do we see some significance in terms of the coefficients, but the magnitudes are much smaller, much more muted than what we saw before. In terms of prime and tax-exempt securities. These difference and difference estimators are based off of indicators of whether a fund is part of a top 5 fund family. And the results are mostly robust to how I choose as the ones, the fund families that have advantage over the rest. So I can use market shares as well in terms of these difference and difference estimation. And so this, instead of having an indicator variable, what I'm looking at now is just family market shares after the regulation. And this is interacted with a post reform indicator. And what we see is that families that typically have higher market shares raise their interest on these securities. So in the tax exempt and the prime, raise their interest in these portfolios, in the tax exempt and in the prime categories of money market funds in the 6-month window after the money market reforms. And we don't really see anything, at least significantly, dramatically happening for government money market funds. So the things that change, I mean, this is one of those tests where I think, it's kind of interesting that the things that changed are size and concentration between these regulations, especially within the kind of the 3 and 6 month bandwidth of these reforms. And these are tax exempt and prime funds are the only categories where we see any significant difference. So for the last part, I wanted to zoom out a little bit and just look at the microstructure of individual securities. Remember, tax-exempt funds are almost entirely, or 70% of tax-exempt funds are invested in what's called variable rate demand notes. And these are float rate notes, similar to float rate notes in treasuries. But these securities are designed almost entirely for money market funds. They are always marked to par. So if you buy one share of any specific security, it's always worth par value in the variable rate demand notes. The market values of these securities never change over time. What changes over time is the yields that they pay their lenders. And these assets are really designed with money market funds in mind. Their rates are set by remarketers, which are the parties paid by the issuers to set rates. And these are the biggest remarketers used by variable rate demand security issuers. So they're typically investment banks, the largest remarketers working in this specific market. And we see that there's actually a large interaction between the top marketers and fund advisors. So the ones I circled here right now are both remarketers, so guys who tell you how much interest you have to pay, and also parties to which you pay these securities. And I mean, the reason I'm examining this is because the relationship between these parties are very obvious ex ante. Merrill Lynch is going to have a relationship with Merrill Lynch. JP Morgan is going to have some type of institutional relationship with JP Morgan. For Fidelities and Vanguards, it's less obvious. So let's just look at securities held by JP Morgan and see the variation in their rates over time. So you see that Merrill Lynch, JP Morgan, Wells Fargo are on both of these tables. And what I'm going to do is I'm going to just take all the securities remarketed by JP Morgan, remarketed by Merrill Lynch, within the period after the 2016 reforms, and look at whether their rates are higher or lower for assets that are held by their affiliated money market funds. So if an asset is owned by JP Morgan and its rates are also directly set by JP Morgan, on average, we see that around 2016, these assets had anywhere between 1 to 2 basis points of higher yield payments than other assets. And this is indicative of some type of vertical integration story. I think that's kind of all I have in terms of this talk. Ultimately, this paper ties profits and revenues to a firm's a money market fund's primary industry organization characteristics. A portfolio's lending rates are positively related to a fund family's market shares. And I think this adds to a large literature on shadow banking, a new dimension to how these institutions are not really just simple pass-through delegated managers. Funds collect resources, generate gross alphas, and in this case, negotiate and select portfolio assets based on a fund family's complete profile. And in the process of kind of looking at this association, we evaluate the reforms of 2016 directly through the lens of industry concentration and competition. Reforms led directly to an increase in the market shares of top delegated asset managers and a higher cost of capital in the most concentrated prime and tax exempt borrowing markets. I think together the results indicate a trade-off between, say, a targeted macroprudential regulatory reform and the cost of capital for borrowers. So that's as much as I have, and thank you so much for sitting through this with me.
Thank you very much, Chen, and thank you for the comments. So for those of you who have some additional questions, I encourage you to